Finance Minister Bill English, who joins us now from Wellington. Bill is also Deputy Prime Minister and Minister for Infrastructure. Bill English, thank you very much indeed for joining us. What is your message at the moment for the markets?
Oh, that we're in reasonable shape and we're on track to get the government books in order. We've got relatively low sovereign debt. We'll peak at about net debt at about 30% of GDP, and we're looking at getting to budget surplus within 2 to 3 years. Now, of course, there's some risks if world growth is affected by these recent events, but even if commodity prices come off, and it looks like they are, we're reasonably confident that we can get sort of steady 2 to 3% growth over the next couple of years.
Now, what are you doing? What measures can you take to engender more confidence there as far as the New Zealand economy goes and indeed the New Zealand market goes?
Well, we've been pretty busy on that over the last couple of years. So at the same time as we've been working to get through the recession, deal with earthquakes, we have been on a longer-term structural reform program. And the key elements of that have been a big investment in infrastructure so that we've got a competitive, productive infrastructure to assist our export sector. We did major tax reform just last year, a big switch from indirect to indirect taxes with cuts in taxes, in income taxes and taxes on savings. And then this last year we've done quite a big fiscal consolidation, public sector reform, both to get back on track to surplus, but also to get the government part of the economy much more competitive and efficient. So that's a pretty good platform for good export performance looking ahead, and just a more higher productivity in our economy. So we're focusing on the things we can influence, because of course these world events are buffeting everybody. We can't influence them, but we can get ourselves in shape to do better, whatever those external circumstances are.
Yeah, I mean, John Key recently, the Prime Minister, your boss, saying that there was plenty of room to manoeuvre when it comes to monetary policy. I think interest rates are 2.5% there. Now, if this global crisis deepens, would you support another interest rate cut then, move towards, well, 1%, let's say?
Well, I mean, that'll be up to our Reserve Bank Governor, who's quite independent. But it does. Your question just illustrates how quickly circumstances change, both in Australia and New Zealand. Just a couple of weeks ago, there was most economists predicting interest rate increases in the relatively near future, and now within a couple of weeks they're talking about cuts. So it's pretty hard to guess, isn't it? But certainly there's tools available there with monetary policy, because our official rates are higher than in a lot of developed countries. We've got room to move where they haven't, and I think that just adds to the resilience that New Zealand has. Relatively low sovereign debt, a bit of room on interest rates, political stability. We're actually able to get decisions made, and we've got reasonable prospects with our exports increasingly swinging to the faster growing Asia Pacific markets.
Yeah, and well, with that in mind, of course, that's one of the reasons why we've seen the New Zealand dollar get up to these highs, unprecedented highs of late. Although we've come off a bit, how badly is it affecting some of your exporters?
Well, you know, the dollar's gone from 80 cents to it got to a peak of about 87 or 88 against the US dollar, and it's back down to the low 80s, and that's all happened in about a month. Certainly at those elevated levels, it's a headwind for our exporters. They've had 4 or 5 years now with the exchange rate above 70 cents US. To their credit, though, they've become very competitive, resilient companies, and while it will take a bit of cream off export growth, they're fundamentally sound, and the demand for our food-related products, which are our biggest exports across the Asia Pacific region, is still fundamentally sound, even though prices are bound to fluctuate in this environment.
Yeah, so, you know, what you talk about the environment here, of course, and this has been worsened to some extent for the New Zealand economy with the disaster that you had in Christchurch. How are things coming along there? And also, what has been the follow-through from the Japanese earthquake and tsunami there as well?
Well, it's certainly made insurance markets a bit jumpy, but I think because we've got a fairly stable political environment, the rules are pretty clear here. The insurance companies are gradually coming back to the market. The Christchurch rebuild is going to be about 8 to 9% of GDP over the next 2 or 3 years, so we've taken the hit on growth from the earthquakes occurring, and we've got the benefit of the rebuild ahead of us, because 8 to 9% of GDP has to be spent in that city over the next 2 or 3 years, and the process, while difficult, is actually moving along at a pretty good pace. I mean, we're rebuilding the confidence so investors will be able to come back into what is going to be almost a greenfields central business district rebuild in a city of 400,000 or 500,000 people.
Bill English, also, I'll ask you more about Japan and how it's affected the New Zealand economy in a moment or two. But despite the cost of what's happening in Christchurch, I want to get back to what's been happening with the New Zealand dollar as it has been rising. I know it's down today in the last few days, but as we've seen it lurch upwards, is there a point where you start supporting a move by the Reserve Bank there to come in and support the dollar to weaken the New Zealand dollar?
Well, look, the Reserve Bank has the capacity to do that, has the ability to do that. We don't have the kind of large reserves that help the market take intervention really seriously. So the bank has to pick fairly precisely the market conditions where intervention by the bank can have a magnified impact beyond the actual positions that it's taking. And that's up to the Reserve Bank Governor to make those decisions. Those conditions don't look ideal at the moment. Generally, our government policy approach is that the market sets the exchange rate. Countries that have tried to intervene have either taken a bath or failed, and so we wouldn't set a lot of store by that. We set a lot more store by getting our competitiveness right in the domestic economy, getting the free trade deals and access for our exporters, a process that's going very well, China and India and so on. That's what we're focusing on more than relying on intervention.
Yeah, and well, of course, you do your biggest nearest trading partners, Australia. I think it's 126 or thereabouts to the New Zealand dollar, the Australian dollar, that is. I mean, would you describe that as a competitive rate?
Well, that's been one of the things that's helped over the last couple of years, is that Australia is our biggest single export market and certainly our biggest manufacturing market. And we have been more competitive against Australia than we have for probably the last 15 or 20 years. And I think our policy settings are becoming more competitive as well. We've been able to maintain a program of consistent reform over the last 2 or 3 years that's helping our exporters. So the cross rate with Australia has been helpful, and that's helped offset some of the challenge that we've had from this high US dollar cross rate. I mean, we've got contending forces here. The New Zealand dollar is reasonably closely correlated to commodity prices. As they come off, the dollar tends to follow. As they go up, the dollar tends to follow up. On the other hand, you appear to have a structural shift in these exchange rate relativities with the systemically weaker US dollar, euro and sterling. And we're just adjusting to learning to live with that long term.
Just very quickly here, how would you characterise the New Zealand economy in the months ahead? I think John Key, your Prime Minister, again said that it could be the next best investment destination. Well, it's going to, compared to the rest of the world, a lot of the rest of the world, except probably Canada and the Scandinavian countries, it's a lot in that kind of category. We're looking stable, politically stable. Our policy settings are stable and longer term. We've got through the recession pretty well, and we've got good prospects for predictable and moderate growth, and that puts us in a good position to weather some of these storms, which I think are going to keep coming back, because the underlying issues in Europe and the US are around large debt are going to probably continue to worsen actually before they get better. Bill English, thank you very much indeed for joining us. Bill English, Deputy Prime Minister of New Zealand, also the Finance Minister as well.